Great. If you've been watching the markets lately, you know it's been pretty wild out there. We're seeing these massive, gut-wrenching swings in everything from silver to Bitcoin. But what if I told you this volatility isn't just random chaos? Today, we're going to break down the powerful forces that are coiling up just beneath the surface and why a really major move could be right around the corner. So what is really going on here? We're seeing some truly breathtaking moves, not just day to day, but sometimes hour by hour. It feels chaotic for sure, but as you're about to see, there's actually a pretty clear pattern emerging if you know where to look. I mean, just take a look at silver. In one recent session, it rocketed up over 6%, hitting new highs, only to completely reverse course and crash a staggering 10% from that peak. A swing like that, that's just not normal price action. And hey, it wasn't just silver. We saw an almost identical story play out in gold, which plunged nearly 9% from its own session highs. When you see major assets swing around like this, it's a huge red flag telling you that something much, much bigger is happening under the hood. It's a classic sign of massive leverage, basically borrowed money, getting forcibly washed out of the market, and fast. And here's the crucial point. These incredibly violent swings aren't just random market noise. They are signals. They're telling us that the very structure of the market is changing. And nowhere is this tension clearer than in our main case study today, Bitcoin. Okay, so let's zoom in on Bitcoin because honestly, it gives us a perfect window into this whole dynamic. For months now, its price has been trapped in this sort of artificial chokehold, but that grip is finally starting to loosen. You see, for a long time, Bitcoin's price has been dominated by something called the options wall. The easiest way to think about it is like a giant gravitational force. It was created by the largest options expiration in history, and it forced dealers to constantly buy and sell just to hedge their own positions. The effect? It basically pinned the price in place and sucked all the natural energy out of the market. And now, it's gone. Those contracts have expired. So for the first time in a long time, the market is free from that artificial pressure. The big dealers' influence has shrunk, and now the rest of the market, well, they can finally make their move. Now, if you look at the technical picture here, it's just fascinating. Bitcoin is literally being squeezed from two sides. You can see it's pinned below that descending resistance line, pushing it down, but at the same time, it's being held up by this rising trend line of higher lows. With volatility just collapsing, the price range is getting tighter and tighter. It's a classic coiling spring pattern, just building and storing up kinetic energy for a huge explosive move. So we know a huge, violent move is pretty much inevitable at this point. That energy has to release. But of course, that's the billion-dollar question, isn't it? Which way is it going to break? To get a clue, we need to zoom out from the charts and look at the much bigger picture. Because here's the thing. No asset ever moves in a vacuum. The charts, the technicals, they tell us that a move is coming. But it's the macroeconomics, the fundamentals, that tell us why it might be coming and which direction has the wind at its back. And this right here, this is the core logic that you just can't ignore. It all starts with governments spending way, way more money than they bring in. This creates a mountain of public debt that just keeps growing. So how do they deal with that? Well, they have to force central banks to pump liquidity into the system. And where does all that newly created money have to go? It flows right into financial assets. It's a simple but incredibly powerful chain of events. And look, this is not just some abstract theory. Take a look at this chart of the US public debt versus its GDP. You don't have to be an economist to see which way that line is going. It is on an explosive upward trajectory. This is the massive problem that forces the hand of policymakers everywhere. And if you want proof that this is happening right now, well, here it is. The M2 money supply, which is just a fancy way of measuring the cash in the US economy, just hit a new all-time high. It's growing at over 4% a year. The bottom line is the money printer is already fired up and running. Okay, so we've got a technical setup that's ready to pop and a macro backdrop that guarantees more and more liquidity. But hold on, there is one final massive piece to this puzzle, and it might just be the most powerful catalyst of all, a coming wave of regulatory change. And the crazy thing is, we're not talking about some far-off, distant future here. This timeline is surprisingly close. We have specific, concrete dates to keep an eye on. Starting late next year and into early 2026, two huge things are set to happen. First, U.S. banks are going to have their capital requirements lowered. And second, a major regulatory clarity law for crypto is expected to finally pass. These aren't years away, they're right around the corner. Okay, so how do these two things actually work together? Well, it's pretty simple when you break it down. The crypto law provides the clear rules of the road that big institutions have been waiting for before they can really jump in. The banking rule change frees up trillions of dollars on their balance sheets, giving them the actual capital to make those investments. So one provides the green light, and the other provides the fuel. Together, they are designed to open the floodgates for institutional. Now, if you're wondering what kind of an impact this could really have, you just have to look at what happened last time. When this exact same bank capital ratio was temporarily relaxed back in 2020 because of the pandemic, it happened to coincide with one of the most explosive bull markets in the history of crypto. Now, history doesn't always repeat itself, but it very often rhymes. So let's just put it all together. We have assets coiling up like a spring, ready to explode. We have a global debt crisis that basically guarantees more money printing. And we have a regulatory shift on the horizon that's about to unlock a massive wave of institutional capital. So the question isn't really if a big move is coming. The real question is what happens when all of these powerful forces converge at the exact same time.